Right, portfolio update time. I've got nothing to hide here, so I'm going to share every single investment I have down to the last penny. I want to use this channel to do two things. First of all, I want to inspire people to hopefully try and get into investing and do it for the long term. And I also want to use it to track my journey to financial independence. So I'm going to track this portfolio that I have over the next 10 years because that's my time horizon. I want you to see that if someone of, let's be honest, bang average intelligence, who dropped out of university, who barely has a couple of A levels to rub together, can do this, and so can you. My financial independence number is 500K. I've currently got about just short of 40K, depending upon which day you look at it. So that means I'm 8% of the way there. And I want to get to 500K by the time I'm 50, so that gives me 11 years to do so. Might not sound like I've made that much progress against that target, but I'm pretty pleased with it. It's going in one direction, and that's up. Now, I have to admit, at this point, given what's happened this year, that's mainly because of deposits rather than growth. But it's been one hell of a year, and I only started this 3 years ago, so it's pretty much to be expected. So I've got two accounts that I've used as my ISA provider. The first one was Hargreaves Lansdown that I used 3 years ago to get myself up and running. And for the last 2 years, I've been using Trading 2 and 2, which in my opinion, if you're based in the UK, it is the best broker there is out there. It's the cheapest. It's got the best platform, and they've also just started taking on new customers. So if you want to get yourself a free share and get signed up to Trading 2 and 2, there's a link below. Use that, deposit some cash, and you'll get a free share. Now, bear in mind, you won't get that free share if you just Google it. You need to use that link in order to be able to get it. Right, let's quickly start on Hargreaves Lansdown. I'm not going to dwell on this one because I haven't really deposited anything to it for the last few years, but there are a couple of key things I want to go over. Now, first thing you'll notice is I've got two accounts. I've got Stocks and Shares ISA, and I've got the Fund and Share account. That is because there's fees with Hargreaves Lansdown, unfortunately, and I can't pay for those fees through my Stocks and Shares ISA because that means I would need to deposit some cash. As you can see, I've got zero available balance, and I can't deposit into a ISA when I've already got one up and running. So the way Hargreaves Lansdown lets you get around that is you can open a Fund and Share account, put some cash in there, and then it will take the fees from the Fund and Share account. Otherwise, if you don't do that, they'll sell off some of your holdings, and you don't want that to happen because that's going to impact on your growth. Now, one of the worst things about Hargreaves Lansdown is they don't show you a chart to see where you've been up, where you've been down over the last few years and months. So you have to use your memory to work out where you were. So the best I've been in this portfolio is 40% up. The worst I've been is about 20% down, right when we saw a bit of a crash towards the beginning of this year. Currently tracking at around 27% up. So that represents £2,500 up in this portfolio. This is a good example of a portfolio where you just do absolutely nothing. I haven't touched this for over 2.5 years now, and it's ticking along nicely, despite a couple of the biggest drops in recent memory over the course of the last couple of years. It's doing quite okay. And I'm not going to go through everything today, but there is something that's bloody glaringly obvious. It sticks right out like a sore thumb. It is that Shopify stock, 62% down. It represents my worst performing stock my entire portfolio. So why is it performing like that then? So Shopify, more like Jesus God, why, has had a pretty tumultuous couple of years, should we say. So look at this article then in Seeking Alpha. By the way, I've got a great Seeking Alpha offer coming up soon. I can get you some really cheap access to Seeking Alpha. So look out for that in the next couple of weeks. It is the best analytics platform as far as I'm concerned for stocks. But if we look at this article here then, that was published on the 18th of August. Shopify is the long-term opportunity worth the short-term pain. So with the conclusions being here, the stock is almost 80% down from all-time highs. This is due to returning to pre-pandemic norms, a management miscalculation about the potential growth in the sector, which in turn has led to a decrease in operating margins. Now, the upside is that a lot of analysts have got this down as a buy now because it is quite so beaten up, and the management seems to have taken some corrective action that is probably going to stabilize it a little bit over the course of the next couple of years. Now, the numbers are all over the place when you look at some of the financials, but I don't want to panic sell. I'm not someone that's going to drop out of a stock just because it's gone through a bit of a decline. I'm going to keep an eye on it over the course of the next year at least, but I have to say I am worried about it. 66% down. That's quite a drop. On top of that, results came out in June. Now, they weren't good, but they were no worse than feared. So let's just see over the next couple of quarters what those numbers start to look like. Right, then I want to touch on Aviva quickly. So a couple of months ago, we got a return of capital. For me, this worked out at about 180 quid. So what I decided to do with that cash, instead of putting it back into Aviva, because of bloody HL again, if I wanted to put 180 quid back into Aviva, I would have had to spend about 12 quid to buy. So nearly, what's that? About 8%. I would have lost 8% immediately. So I didn't want to do that. So what I did instead is I chucked it into the S&P 500. So that's why that's gone up a little bit. What I ideally would have liked to have done is reinvest it directly back into Aviva. So Aviva returned £3.75 billion to investors over the course of this year, so not too bad. Obviously, they've done better than expected, so that's why they've done that. On top of that, I have had, over the course of the last couple of years, £62 in dividends from this company, and I have had £180 in return on capital. So that's £242 I've had returned. On top of that, it was a holding that I bought for 500 quid. It's now worth 626. That's an extra 126 quid. So I've nearly doubled my position into Aviva, if I'm honest. So I'm really happy with that. It's one of those ones where you go, Jesus, why didn't I buy more of that when I could? But can't all be clairvoyants, can we? I'm not going to dwell on anything else here specifically. You can see what these holdings are like. We've got Tesla. So the three specific holdings I've got is Tesla, Shopify, and Aviva. Tesla's 150% up, and the others are ETFs that cover the world, basically. Cross from Japan, South Pacific, S&P 500, emerging markets, European, and the FTSE 100. Less said about that, the better. Watch my last video if you don't know what I'm talking about. Next up, we have got Trading 2 and 2. This is the ISA that I've been using for the last 2 years. As I said, it is the best platform out there. It is. Is it the cheapest? If it's not the cheapest, it's one of the cheapest platforms there is out there. It is also the funnest. I just love this little app. It's pretty cool. So don't forget, if you want to get yourself a free share, click the link below. So I have got 4 pies within my Trading 2 and 2 account. I have got £25,400 invested, and I'm sitting at 25,131. Represents a 1% decline. Again, I started this portfolio in March 2021, so it's not surprising that it's been beaten up a little bit. 4 pies. Now, there is going to be some change here, and that is within, if you ever watched one of my videos before, you see I've had these 4 pies for years now, but I'm going to be changing the new car pie, because originally the idea is to have this pie, put 50 quid into it a month for 10 years, and then in 10 years I can buy a car. But that means I need to take out what I want it to be worth in 10 years is 10K. It means I'm going to have to take out 10K of my investments just to pay for a new car. I don't want to do that. It doesn't make sense to me. I don't want to be taking out of an ISA when I'm still trying to grow my pot. So I didn't really think that one through to start with. So what I'm going to do is work out within here what holdings we've got. We've got some good holdings. We've got Tesla, which is doing well, 36% up in this pie as well as the other one, 150% up in the other one. Clean energy, which is I've had a massive recovery over the course of the last 6 months or so. Now, don't forget, with clean energy, I actually want to add more to this. I might take it out of this pie and put it into my normal one. Clean energy over the next 20. How many big businesses have got net zero targets over the next 20, 30 years? Every single one. In order to meet those targets, they're going to need to find new ways of producing clean energy. Within each of those businesses, the leadership team are going to be targeted on clean energy. They're going to be targeted on sustainable growth within the business, sustainable from a climate perspective. And that means that there is going to be some massive winners in this sector. So I need to increase, as far as I'm concerned, I need to increase my allocation into this ETF because I think it's going to be a goer going forward. Uber, which has just recorded some really good numbers. It's up 56% in the last 3 months. It puts me back into the green. And this is because of really solid earnings. And they've also got a projection of pretty good growth for 2024. Now, I am concerned about Uber because is it a really high quality company that delivers cash flow regularly, consecutively with good growth outlooks? I'm not 100% convinced. So it's on my watch list. It's not as quality a company as some of my other holdings. So I am concerned about it. I'm back in the green now, which is great. Just keep an eye on that one for the time being, I think. And iShares automation and robotics and iShares electric vehicles, stands to reason what those are. But I'm thinking about probably cancelling this pie, taking the cash out and putting it across some of my other ones, and then working out a different solution for when I need to buy a new car in 10 years' time. But it doesn't make sense to take money out of this pot for me. Now, the growth pie, I just want to look at now. Now, growth businesses over the course of 2022. They've not had the best year, let's be honest. So this one is 26% down. It represents 1,100 quid down. If I was to take this out of my entire portfolio, it would look a lot better. But in here, we've got holdings like Alphabet. No concern there. I'm going to continue to add to that for years. Really comfortable with that one. Disney. There's mixed bag reviews on Disney. I'm comfortable with it. I think that they will return to a dividend at some point in the future. And I think that that will recover from where it has been. Amazon, again, no concerns as far as I'm concerned. That's going to be a behemoth for the next 20, for a generation, let's be honest. Now, Netflix, I am concerned with. Subscribers have been falling, yes, but I do think it's overvalued. It's another one like Uber. Is it a really high quality cash generating business that is going to grow for the next 20 years? I don't know. I just think it is too volatile a sector. People's viewing habits, people's consumption of media changes every 3 or 4 years, it seems like. And are Netflix going to be in a position to be able to keep up with that changing demand going forward? I've got question marks on that. Virgin Galactic, I am going to do an update video on that soon, so we won't go into that too much. It has been beaten up again even further over the last month or so. Rolls-Royce, I'm also going to do an update video on that soon, so I'm not going to delve into that too much. But those two at the bottom, those three at the bottom, equate to nearly £1,000 decline in my portfolio. So obviously it's on paper. I haven't released anything yet, but that's the reality of the situation of growth businesses. Now within Dividend, I really like my dividend pie. I've got all sorts of, this is where I've got really high quality businesses in here. So Microsoft, 7% up at the moment. Apple, 32% up. I've got high hopes for that in the future. I wish I had more in that position, if I'm honest. I might be dripping a little bit more extra into that. Now, Realty Income just released yesterday this. Have a look at this chart. It's increased its dividends again. So that's the Realty dividend growth. 117 consecutive increases since 1995. 117 consecutive increases in dividend over the course of nearly 30 years. That's a high quality company right there. So that gives me my exposure into property. Now I'd love to have some actual physical bricks and mortar property that drives some cash into me, but that's not a reality at the moment. So, reality. That's the reality. Reality income. Johnson & Johnson ticking along nicely. Pharma company, consumer goods company as well, big behemoth. 3M, we talked about it last time, still struggling with some lawsuits that are hanging over it. No concerns with it though. Nice, high quality, 5+% dividend business. Pepsi doing really well, really good on paper in terms of returns, but also a nice little dividend that trickles in every quarter. Same as Unilever, massive global consumer goods business, one of the best in the UK. McDonald's, love McDonald's in every way. I had a McDonald's last night. And it's just the way that they revolutionize the business every few years. Look at the restaurants, for example. They completely redesigned everyone in the network. They look so much better now. They're so much more welcoming. Always got aircon, always got free Wi-Fi, always got tablets for the kids, always quick service, and really good value. The price you pay for McDonald's meals hasn't gone up anywhere near as high as some of the other rates of inflation in the UK. So I love a good McDonald's, mate. On top of that, they now do delivery. So that's the one thing that they were waiting for. Last few years, they've moved into delivery. And Christ, we probably have it once every couple of weeks. I shouldn't admit that. My missus would be kicking off admitting that on this sort of forum. But yeah, love it. I'm loving it. And legal in general, down a little bit. No worries there. Really high quality dividend business. Finally, in my funds, this is where we've got the majority of my cash. Only slightly majority, just above the dividend pie that I've got. And in here, we've got S&P 500, FTSE All World, emerging markets. So those three... those are your big bets. Those are where you should be putting the most money. Those where I should be, not going to give you advice, be putting the most amount of my cash into. I need to increase my allocation into those probably. So that represents £6,500 nearly in there in a portfolio worth £25,000. I probably need to increase my allocation there. FTSE 250. So the next 250 biggest companies in the UK after the FTSE 100. Not convinced. Worried. I think small businesses to medium businesses in the UK are going to have a tough couple of years. Keep an eye on that one. And iShares NASDAQ biotech ETF. I've mentioned it a number of times before. I see this as being the next tech sector. The solutions that are going to come out of biotech for the human race over the next 20 years, they're going to be groundbreaking. They're going to transform the world. So we're not going to go into human genome sequencing and all that sort of stuff right now. But the businesses within this ETF, I think this is going to be one of my most successful ETFs over the next 20 years. Now, I did say I was going to share every single portfolio that I have. I've also got this free trade one that we did used to use to track that beating the market thing that we did last year. This is full of, oh look, Tesla's just come into profit, but everything else is massively in the red. Still haven't decided what to do with that. Now, if you haven't watched the channel before, this is just a little fun portfolio that we use. We try to make any gains in there we can donate to charity or whatever. This is not about proper investing. This is just around trying to beat the market and have a bit of a play. If you've got any ideas of how we might do that going forward, I haven't done anything in here since we last updated it on a few months ago. Let me know. Now, don't forget that Trading 212 link is below. Please feel free to use that. And I did do a video this week on why I am quite so concerned with my UK ETFs, my FTSE 100 and FTSE 250. I think that you really need to have a look at this if you are invested or thinking about investing into the UK.